and welcome everyone from wherever you are in the world. This is our very first Nedbank Private Wealth Investment Report. So many of you will be familiar with the investment webinars that Nedbank have run previously, but this is building upon that to give you more insight and information and the chance for you to quiz our guests directly. So let's see who's going to be joining us today. First up, I'll be speaking with Tom Caddick and Simon Watts, who are from the investment team, and they're going to be explaining what's going on in the markets at the moment and also what they're doing as a team to ensure that your investments are still performing as you'd expect. And then it'll be over to Senior Credit Specialist Chirag Patel, where he's going to share some case studies of the types of client that Nedbank Private Wealth have helped when it comes to borrowing, and also a bit about the property markets at the moment. But also, have you ever wondered how your emotions can influence your financial decisions? So Simon Prescott, who is the head of wealth planning and award-winning as well as of last night, he's going to be coming along with his colleague Anna Slater, and they're going to be joining me to delve into all of that. Honestly, apparently they're going to be talking about horses and prehistoric times, and it all definitely sounds very interesting. And finally, Tom, Chirag and Simon are going to be answering your questions live. So as and when you think of any, just send them in via the panel on your screen, and then I'll put them to our guests. But let's get on with the show. And I am joined by Tom and Simon. So hello to both of you.
Hi, Gemma.
Good afternoon. We're going to come to you first then, Tom. So let's kick off with what the most significant things are that have been happening in the economies over the past couple of months, because it's been a crazy few years. That I know for sure.
That
We've all experienced that.
Absolutely. And I think when you turn into the new year, it's often easy to think that you're going to have new conditions, new environment, and the reality is, we've seen a continuation of a lot of those economic conditions that we saw in 2022, which was a horrible year. But really, the focus so far this year has been on inflation and the impact of inflation on central bank thinking, i.e., base rates. That's been one of the.
Is that why my mortgage has gone up?
Unfortunately, yes, it is. Yes, it is. So those have been really the main factors, and that will have a big influence on investor expectations going forward. And I know we'll touch on that shortly. Now, at the same time, in terms of the backdrop, what we've seen is a few what we think of as being relatively isolated incidents, but they've caused something of a ripple effect. So more recently, what we've seen has been the failing of SVB, or Silicon Valley Bank, which I know has caused some contagion within the markets in terms of worry around the financial sector, but realistically was fairly self-contained because of the very nature of that bank. But that did cause some concern. At the same time, we saw fallout from Credit Suisse. Again, relatively contained. That's been an institution that has had a number of issues for probably the last decade or so. That's caused some jitters within the market. Main backdrop from an economic standpoint has been inflation and the reaction of central banks.
Okay, so how have the markets reacted to all of that? How's that reflected?
I mean, last year was awful. We know that. For risk assets, for any kind of investor looking at equities, bonds primarily, both saw significant falls in value. We saw something of a relief rally and something of a sort of a return to some euphoria coming into markets early in 2023. Things have leveled off somewhat. We've seen a return to some volatility, particularly within equity markets, and largely on the back of SVB, as I mentioned, Credit Suisse. Earnings season has been actually reasonably upbeat. So a lot of that has fed through. Equity markets have remained fairly resilient so far, and mostly reacting to inflationary news. And we've had a strange situation where what feels like good news is bad news and bad news is good news on markets, largely because strong economic news actually has sort of laid the pathway for an expectation that central banks will stay higher for longer or continue to increase rates, whereas bad news, anemic growth in markets can lead investors to think that central banks will start to moderate and move to a more accommodative position. So we've seen a bit of a return of volatility in markets, Fixed income areas have remained relatively buoyant. Let's not get into the yield curve and what's been going on there, but actually that has been a relatively bright spot in markets.
We like that. Bright spots are very good. Simon, we're going to come over to you now, and thank you. If that's the impact, what have you been doing in the Ned Bank private wealth sector as a result?
Yeah, sure. So in terms of positioning, Gemma, I mean, in terms of the I suppose the short answer is we're becoming increasingly more defensive. And that's primarily because we expect growth to slow because of the impact of higher interest rates. Yeah. I mean, central banks are really trying to get inflation down by raising interest rates and slowing growth. And then with that backdrop, it is really quite a challenging environment, we think, for equity markets. So that's why we've been going underweight more recently.
So what do you mean by that exactly?
Yeah, so in terms of underweight, we manage against kind of long-term asset allocation, strategic benchmarks in order to meet our clients' objectives. But according to
being a bit more cautious.
Yeah, exactly. In terms of trying to changing market conditions, we try and change the allocation against the long-term asset allocation. So in terms of within equities, we favour at the moment kind of more of a quality bias. We like quality stocks, and that's because they tend to do better in a kind of more economically slower environment. And in terms of the quality, the kind of types of characteristics quality stocks have, they tend to have kind of like stable cash flows, a robust balance sheet, but also kind of like some margin protection. A good example of which would be kind of Microsoft, which actually has generated some good results this week. Other areas, we really like fixed income in the current market. I mean, Tom alluded to this in terms of the fact that in this higher rate environment, you can actually earn a higher level, investors can earn a higher level of interest. So we feel that fixed income is actually a good place to be, especially within government bonds. We prefer government bonds rather than corporate bonds because in a slower growth environment, corporate bonds tend to underperform because of kind of concerns over recession and rising defaults. In other areas, we like real assets. I mean, real assets in this current environment where we've got high inflation, and real assets provides you some inflation protection. The way we define real assets is it incorporates kind of commercial property, infrastructure, but also commodities as well. And within that, at the moment, we have a preference for infrastructure. So what we consider within infrastructure is like utilities, electricity companies, water, gas, etc., and also renewable kind of energy companies such as wind farms and also solar energy. What's great about this, especially in the current environment, is it provides an offset essentially for everybody seeing their electricity bills going higher. So it provides a great offset because this part of the portfolio is really benefiting from higher electricity prices. So renewable energy is benefiting from high electricity prices, but so is our kind of our investments within infrastructure, where we have exposure to electricity companies. For example, E.ON is one of the holdings within this fund, and that's done exceptionally well this year. It's up 20% so far.
Got you, yeah.
And then finally,
so those things are very tangible for customers, aren't they?
Exactly.
And so what you're saying is you literally adjust your outlook depending on the economic climate and the political climate and everything that's going on.
That's right. That's right. And then real assets obviously give you that kind of inflation protection that we're seeing kind of in the current environment, higher inflation. Another area we really like at the moment is alternative strategies. And that's essentially alternative strategies to us is kind of investments that have act differently to your more traditional asset classes like equities and bonds. And that's,
so what do you mean by those?
So they actually provide you, what's really good about that is it provides you some diversification. So they move differently to equities and bonds. And within that, we have this kind of eclectic mix, really, of different asset classes. So we have things like music royalties, we have asset-backed lending, we have private equity, we also have energy storage, so essentially batteries. So they essentially react differently to different conditions. So provide you really nice diversification. So, yeah. I mean, in summary, I mean, we are increasingly defensive, but we have a nice, broad, diversified investment base.
So those strategies can work alongside the more sort of traditional strategies.
Exactly.
Okay, that's really interesting. So, Tom, looking to the future, get the old crystal ball out. What is on the horizon that could impact investments, do you think?
I mean, it's going to be a continuation
Yeah.
of, there's no point in thinking very short term.
Right.
Because that's mostly driven by sentiment and short-term noise, but mostly the focus is going to be on inflation and central bank. So often you get a big focus on central bank rhetoric and the sort of guidance you're starting to get through. And people are looking for increasingly early warning signs coming through. And really, we're going to see inflation as being one of the key drivers. What we've seen is high, relatively stubborn, but peaking levels of inflation. What we now need to see is inflation coming down more meaningfully rather than by sort of 5-10 basis points at a time. Yeah. And I think that's going to be one of the key drivers. It'll drive how things settle from a central bank perspective. It'll drive things like the cost of capital for underlying investments. And it also gives a reference point for the way in which investors price their own assets. So all of those things are going to drive that sort of mid-term outlook.
Okay, thank you. That's interesting. So finally, Simon, is there anything that you're keeping an eye on that can reassure our viewers?
Well, I suppose at the moment that we are seeing, as Tom mentioned, kind of quite a lot of noise at the moment. So I think what's really important is to have a really consistent investment process. So we look regularly at valuations, fundamentals, sentiment, and external influences, and we have that as a consistent investment process, and that helps to cut away the noise.
I understood two of the things you said. So just recap, you look at what?
Valuations, so valuations of
got
financial. We look at fundamentals, so economic data and company data. Sentiment in terms of the market mood, in terms of are people positive or negative, and then external influences in terms of events such as Russia, Ukraine.
I was going to say, is that geopolitical, what's happening in China, what's that?
That's right. Yeah.
Okay, got it.
So yeah, but if you were to ask me a specific point, what are we focusing on? It would be inflation, as Tom kind of alluded to. I mean, it is really key at the moment. Central banks are obviously keenly watching that, and it relies on the fact that that's what's really driving interest rate policy. The positive news is we do think inflation is peaking, and that should be not only good for the consumer, but also good in the sense that central banks should be able to cut rates in the future, which should be supportive for markets.
Good. I mean, that just affects everybody, doesn't it? So yeah, that is positive. Okay, so that is just a quick overview of the investment world. But remember, and thank you so much to both of you, but Tom's going to be coming back for our live Q&A at the end of the show. So if you've been listening and you've got any burning questions that haven't been covered, please send them in now. You've got the box on your screen. Also, many of you may not be aware that as well as banking and investments, Nedbank Private Wealth also helps hundreds of clients every year with their borrowing needs and also offer bespoke lending service. So we're going to hear now from Chirag Patel about some of the ways that they've helped clients and also what he's seeing are the property market trends at the moment.
Thanks, Gemma. So what is bespoke lending? Well, being a private bank, how we differ from other lenders is that we have the flexibility to offer a personal service that can be completely tailored to your individual circumstances, not just how well you fit a prescribed set of criteria. The benefits to you of this include both quick decision making and competitive pricing. I want to bring that to life a bit for you now, so let's take a look at a couple of case studies. In the first one, we have Mark and Julia, who wanted to buy a property they had been renting since relocating to the UK from LA. Mark is a US national and Julia is a British national. Mark and Julia were paying £5,000 per month in rental payments before their landlord decided to sell the property for £2.1 million. They had the money to buy it, but it would have meant selling some investments, which they didn't want to do in the current climate. The sale of the investments wouldn't have been a good idea from a tax perspective. The couple had around £5.5 million in investments with various US banks, which generated income annually that they could use as and when needed. However, they also received around £10,000 per month in rental income from their previous home in LA, which had an estimated value of around £5 million. But due to their lack of regular UK income, traditional high street banks were unable to help. However, we could take a more flexible view, looking at all the surplus rental income after management fees and conversion to sterling and also the income generated by their investments. After the couple provided various pieces of information to confirm the income and investments, we were comfortable offering a mortgage over a 10-year term, taking Mark to age 70 on an attractive 5-year fixed rate. In the second example I wanted to share, we have a client who sold his business in 2017 for £30 million, and a majority of the proceeds are held with us offshore. The client is a UK res non-dom for tax purposes, and his onshore UK income is minimal. To plan for his future and to generate more onshore UK income, he wanted to buy 5 high-yielding buy-to-let properties in London, on average delivering gross rents of circa 10% per annum. He wanted to use his main residence, valued at £8 million, to secure the £4.5 million needed to cover the purchase price, stamp duty and refurbishment costs. The plan was to repay the loan by selling the properties in 10 years' time, when his non-dom status may change. We took a forward view on the buy-to-let properties and the anticipated rental yield to support the lending against his primary residence. To provide extra comfort, 2 years interest cover was placed in a block account with us. Once the properties were purchased and let, the annual income reported and proven, we agreed to release the charge cash. So why have I shared these quick examples with you? Well, I think they really help bring to life how flexible we can be when looking at lending requests. How we really take the time to look at a client's individual circumstances, and how one size definitely doesn't fit all. I was also wanting to give you an overview of market movements this year and what I think is the likely direction of travel. To many who purchased a property for the first time post 2008 or are looking to get onto the property ladder, the past 6 months or so in the UK has been a bit of a shock. They've never experienced interest rates at or even close to the present levels. Against the backdrop of rising interest rates, the cost of living crisis, the growing fears of recession, the cost of servicing a mortgage has increased substantially. In London especially, mortgage repayments now dwarf the cost of paying rent, which is the reverse of what we've traditionally seen. This, in turn, has recently seen more and more landlords increase rent to meet their own increased costs. The widening cost gap between owning and renting may also put home ownership out of reach for many first-time buyers and quash the number of sales in 2023. This may cause house prices to fall. Some experts predict the capital may see prices drop by as much as 12%. What about those wanting to move, upsize or buy their next family home? If prices are dropping, surely this is a good time to take advantage. But what if they can't sell their present home due to the lack of first-time buyers? It's a catch-22 situation that no one can predict. So, we've seen base rate increases, primarily to control inflation, with mortgage rates increasing substantially as a result. Is it all doom and gloom? Well, maybe not. Mortgage rates have been gradually coming down lately. The general market perception is for both base rates and mortgage rates to fall later in the year. I think we will need a few months more data to see the true trajectory. There are a number of key inputs for inflation, many of which, like food prices, are somewhat stubborn, but others move more quickly, like long-term energy prices. All of this data influences interest rates and all property metrics. The March to June spring market is underway and will be telling in relation to the performance of the market for the rest of 2023. And I'll be back for our next virtual event in the summer to share my thoughts on that. But for now, thank you, and back to you, Jemma.
Thank you very much, Chirag. And Chirag will, of course, be on our panel at the end of the show. So send in any questions to him using the panel on your screen. We've had loads through already, so thank you very much and keep them coming. Okay, now I would like to welcome Simon Prescott, who is Head of Wealth Planning at Nedbank. And you've got an award with you.
We have, absolutely. We won this last night. It's actually the second time we've won this, and it's an award for total wealth planning, which is an amazing achievement that we've got. We're very, very proud of it. And dare I say it, the PAM Awards are the ones that you really want to win.
Did you have to make an acceptance speech?
No. Fortunately,
did?
there was
Okay.
no. It's not like the real Oscars, but no, it's a real accolade, for what we're doing within the wealth planning department and the whole bank, really, the way we lead with wealth planning.
Yeah.
And it's really external validation of what we're doing actually works.
Yeah, well,
So
massive
it's really,
congratulations, because that was literally last night, and I've picked the award up, and it's a good quality one.
Thank you. So we'll leave it there so everybody can keep seeing that. That's okay.
Absolutely. Okay, so tell me a little bit about what you do and how it differs to what private bankers offer people.
Yeah, absolutely. So it's worthwhile just saying, first of all, that how the bank's set up. So we have very experienced private bankers around the bank who look after the main relationship with the clients. But we very much recognise that we operate in a really complicated financial services world, and not one single person can know everything.
No.
So we really surround them all with specialists. We have investment specialists and credit specialists who we've heard from already. And we have my team, which is the wealth planning specialist. So as a company, as a bank, we aim to lead with wealth planning.
Okay.
And what we mean by that is we want every investment client of the bank to have a bespoke plan and a plan for their wealth. Give their wealth purpose, how it's going to meet their wealth and their dreams and their objectives. So we aim to put a plan into place for every client so they can really see a purpose of their wealth.
So it sounds very personal in a good
Very
way.
much so.
So how do you set about that? I mean, you must have to get to know your clients quite well. So how does that go?
Yeah, so there's two parts to actually building a wealth plan and putting a wealth plan into place. There's one part where we will look at structuring. So we look at ISAs and pensions and more complicated things such as trusts or what we call family investment companies. But that's not really where the interesting stuff happens in my mind. The interesting stuff is really working with a client to really uncover their goals, their objectives, their aspirations, and us being able to show them how their money can help them meet those aspirations.
Yeah.
So really undercovering with them and working with them to see what a successful and fulfilled life looks like.
Does that range quite a lot with different people then?
Very much so.
Yeah.
I mean, everybody has different goals in life, so everybody's different, and that is actually one of the joys of my job, and indeed, dealing with clients such as ours, because everybody is so different. It's really
I think
good,
I would be interested as well, because I'm interested in people.
Yeah, absolutely, and it is a people game. So we do need to uncover the goals, their objectives, their aspirations, but not just those. It's emotions. Okay, so how do they feel about money? Because believe it or not, emotions actually drive quite a lot of financial decision making.
Now that is interesting, because I think people don't usually associate emotion and feeling with sort of the world of finance and planning and everything. But it makes sense to me, because you're talking about people's lives and how they and their family are going to live out those lives. So although I guess the decisions have to be logical, there's going to be emotion mixed up in it.
Without a doubt. So fear, worry, really
Yes,
powerful
I know that.
emotions, massively powerful. They can consume us. And a lot of times that we see a lot of people that fear that they're going to run out of money throughout their life. And with the planning, we can actually show a lot of times that they won't run out of money. And actually, perhaps what they should be worrying about is dying with too much money. Okay.
Right.
So the problem with dying with too much money is you could have enjoyed yourself.
You
more.
haven't had
could have
enough
done
fun.
Precisely. You've built this wealth, you've done very well, so have more fun, do what you want to do. You could gift more to your children, you could help them on the property ladder. We all know property prices are going up. You could help grandchildren and so forth, or you could start to gift to charity and get that fulfillment of that gifting. One of the biggest issues with dying with too much money, in my mind, as well, is a dreaded inheritance tax.
Yeah.
So if you die in the UK with too much money, the government will take a slice of 40% off you. So that's quite an issue. So, and we can certainly help, mitigate some of that and so forth. But I think you said before about shouldn't we make logical decisions? Okay, now, logically, yeah, makes sense. We want to make logical decisions, but 90% of all the decisions we actually make are made emotionally.
I was reading the other day about gut. When you talk about, I got this feeling in my gut, and apparently how important that is, because it's partly chemical, but it's come from the brain, and that trusting it is often a good idea.
Oh, for sure, and we're all made up of chemicals. We are just biology, we're all just chemicals, and we have dopamine, and we have adrenaline, and everything running through us. But the way the actual brain works is decisions actually enter the emotional part of the brain first before actually going into the logical part. And it's instantaneous, But by the time it hits the logical, you then start to rationalise your emotional decision that's already been made. So you think you've made a logical decision, but usually the decision's already been made. And what actually happens is the left side of the brain generally looks after logical decisions, and that takes a lot of energy, a lot of time and concentration to make logical decisions. And the right side is emotional, fast-thinking, instinctual. And in most cases, you use it right because you don't need to think about picking up a glass of water, and you just do it.
Our brains have always been that way, right?
Yeah, absolutely. Developed over 200, 300,000 years from when we were Stone Age, when we were Neanderthals. And the reason it developed for instinctual, fast thinking is because we were hunter-gatherers. You had to go out, you had to catch your prey, you had to make sure you weren't the prey, because if you were logically thinking about those decisions, you were probably picked off by an animal that was thinking instinctually. So if we look at that hunter-gatherer mindset of 200,000 years worth of development and we apply it to the complexities of modern day, well, there's not many predators around anymore, to be fair. There's not many
Different kinds.
Well, there are, but I don't see too many saber-toothed tigers walking around
But
these
you're right,
days.
our brains haven't changed and the world around
Correct.
us has, and we're dealing with different kinds of stresses.
Definitely. And when we try to apply this hunter-gatherer mindset to wealth, which has really only been around 100 years for the masses, you've got 200,000 years butting up against 100 years. So if we want to help shape and predict and help our clients with financial decision makings, we really need to understand how the brains work, why it's thinking that way, and how it's developed over hundreds of thousands of
Take
years.
the fight and flight out of it a little bit.
Yeah, quite.
Interesting. So have you got any other examples that can bring this to life? Because I said in my intro you were going to be talking about horses.
Right, okay,
What
yeah.
was that?
Yeah, so there's a couple of examples. The horses one links to a herding instinct, or the fear of missing out. They're interlinked. Now, we all know about fear of
I
missing
get that
out.
all the time, mainly socially.
We all do. It's not just yourself, it's everybody. So, horses. If we see a field of horses and one bolts, you'll see all the other horses go with it. They have no idea why they're doing it. They just know instinctually they need to go.
Okay.
And it's probably because in the past there was a predator. And if they stayed together, they're safer. So back to how we developed in the Stone Age, we developed to stay within a herd. It was a protective force. We were developed not to stray.
Yeah.
Stay together, you stay alive. And that's still with us today, that herding effect. And when it activates, we don't really realise it's happening. I mean, we were talking an example earlier on, weren't we, about toilet rolls?
Oh, yes, yes. I was saying, like, in the pandemic, when everybody just suddenly said, there's going to be a shortage.
Absolutely.
And then the shortage was created because people had, like, 98 loo rolls just in case.
The herding effect activated. Everybody got into a mad panic about buying
And it's
toilet
happened
rolls.
with fuel
It's
before.
insane.
Yeah.
Absolutely. But that's what happens when the herding primeval instinct kicks in. So if we apply it to markets, for example, in the stock market. So markets start to decline every now and then. We will see money fall. And nobody likes that. So first of all, you've got that panic. Oh my God, my money's falling. But then you start to hear more about it. And it starts to go down, and you hear it on the 6 o'clock news, and it'll say, oh, the FTSE or the UK stock market suddenly lost however many billions. I mean, they never tell you the next day that it's gone up, but that was perhaps another story
Bad
for
news
another
sells,
day.
right? It's like always on the
Absolutely.
negative bias.
But if you're hearing that and you've got the worry that you're losing money and you're thinking that everybody else is sell, that herding instinct suddenly kicks in. So you ring your investment manager and you say, sell, and you've already lost money. It happens the other way. We see the markets start to grow, you think everybody else is doing it, you fear you're missing out, you're outside of the collective, and suddenly you say buy. And you've
Interesting.
probably bought when the easy gains have been made. So you're selling low, buying high, which is completely the opposite way. And we see other examples. We've seen it in housing bubbles, we've seen it in crypto. Lots of people had fear of missing out on crypto and bought in, highs, and then falls.
Has that bubble burst?
Well, it seems to have certainly from its highs where it's fallen
Yeah.
50, 60, 70%, where it goes, again, nobody knows. But a lot of it felt as though it may have been built on the fear of missing out.
Got it.
But the other example I mentioned before, I think the left-hand side of the brain, where the logical side and the emotional quick thinking, the logical side takes a lot of time and energy. Right side doesn't. So, okay, 5 times 5.
25.
Brilliant. That's taken
Stress.
the pressure off me to get that right now. So it's easy. We can do it quickly.
Yeah, we've learnt it by
We've learnt
rote.
it by school.
Yeah.
Yeah, absolutely. So if I was to say 57 times by 35.
I'd be like, oh, thanks a lot.
Okay.
And then I'd have to go and find my phone and get the calculator.
Absolutely.
Or
It
Take some time.
Take some time, take some effort. It's moving into the left side of the brain. A pen and paper would help, but we could probably do it.
I could get there
We could
eventually.
get there, yeah. So 535,824 times by 236,021.
No, I've gone. Yeah.
You probably forgot the numbers I've just said.
I have.
Yeah. So there's no way we can remember something and try and do something so complex in our heads. And what actually happens, the brain thinks about it, it says that's too complicated, it's a lot of time and effort, and you know what, I'm going to paralysis, I'm overwhelmed, I'll leave it there, I'll not do it. So we talked about having a bespoke plan for every
It's like
single
tidying
client.
my son's bedroom. It's too much.
Well,
So I just
there's
closed the door.
Far too much emotions and chemicals to be going on there with
Yeah,
teenagers.
yeah,
and
yeah.
again, I think that's a story for another day that's not really wealth planning. But if we were building a plan for a client over 20, 30, 40 years, we've got their earnings, we've got pension income that will kick in the future, we've got rental income, we've got their expenditure. Okay, I need to pay my bills, I need to go on holiday, I want a new car. We've got asset growth, we've got shares. I mean, Simon and Tom were talking about different types of assets. They have different levels of growth. We've got tax, we've got inflation. It goes on and on.
A lot.
And we do those calculations for you. So if I laid it all out into a huge spreadsheet, Gemma, and put that right in front of you and said, let's discuss this today, what's going to happen?
That's the untidy bedroom. You go, oh, I can't. Yeah, no, but
right.
I get it. Yeah, it's too
is.
much.
You look at it, your brain gets overwhelmed.
Yeah.
It says, forget it. No, I'm just not going to do that. And you go into paralysis and you go into inaction. And what happens if you go into inaction? You're not going to follow through on your plan. You're probably not going to meet your financial goal.
Got it.
So how do we overcome this? So we overcome this by using quite a sophisticated piece of software. We can input the data. It does a lot of these calculations, and it allows us as experienced wealth planners to critically analyse a situation for a client, come up with a really clear bespoke plan for them, and then actually present it in a much more palatable and attractive format and a simple format so they can know what the next steps are.
That's brilliant. And also, I guess for people where time is of the essence, it's just like, just tell me the bits I need to know. And that sounds like that's what that is.
Absolutely,
Yeah,
it can be
yeah.
like that, yeah.
Okay, so that is cash flow modelling, to give it its official term.
Correct.
So it sounds very, very helpful. And we've actually got your colleague, Anna Slater. Now, Anna is a para-planner at Nedbank Private Wealth, and she is going to explain all about this. So, hello, Anna.
Thanks, Gemma. Cash flow planning is a great tool to help us simplify the complex. As Simon outlined, once your information has been gathered and your goals have been established, we can use cash flow software to help illustrate your specific financial future. For many people, this may be the first time they've ever seen their future illustrated in this way and how their assets can help achieve their goals and aspirations. I have an example here to show you today. The couple are in their mid-50s, and running along the bottom of the chart are their ages projected forward until age 100, with each column showing a year. Up the side of the graph, we have the values of their inflows, such as their earnings, rental or pension income. The black line tracking from left to right is their total expenditure requirements per year and includes items such as normal expenses, mortgage costs, children's university costs, tax and so on. While they are working, their total expenditure is approximately £250,000 each year. And on top of the inflow column is greater than the expenditure black line, this shows their inflows from all income sources is greater than their expenditure, which leads to a surplus. Their objective in retirement is to have net expenses of £100,000 each year after tax. Their mortgage will have been repaid at this point and their children's university costs will have also finished. At retirement, we can see their inflows from rental and other income is not enough to meet this £100,000 requirement, and this difference will now need to be met from other assets. Using assumed rates of inflation, we can also plan for this yearly expenditure to increase until age 100. Here we can see the state pension starting in dark blue is added to the rental income, although to meet their expenditure goals, the difference will still need to be met. On this next slide, we can see the couple's balance sheet, and this is all the assets they own, including their main residence in the dark blue, rental property in the light blue, cash savings, ISAs and SIP pensions. The investment portfolio in this instance is shown here and is where expenditure is funded from in retirement, as I had outlined on the previous chart. You'll see here that in this case, as they are UK resident, We will also be using part of their investment each year to fund ISAs to make more of their investments tax-free. Simon mentioned earlier that many of our clients run the risk of dying with too much money. And in this instance, we can see that the clients, even at age 100, still have significant assets left. We can therefore speak with them about whether they wish to spend more or start discussions about planning for succession, such as gifting money to children or charity during their lifetime. What is clear in this example is by having over £8 million left when they pass at age 100, is that a significant inheritance tax liability is likely based on the current legislation, and shows that we can help the client mitigate that by estate planning. From here, our wealth planners will help identify the most tax-efficient ways to draw money down from their various investments and assets and make use of current allowances, exemptions and structures available. This is a very high-level plan, and we can delve into much more detail if required on your investments. We also know that this is only one of a multitude of potential outcomes over 40 years, and we will review your investments annually, adjusting the plan accordingly to make sure that you remain on track. We will also run various scenarios with you. For example, we can assess the impact of taking more or less risk with your investments, different spending needs, making large gifts to children for property purchases, and visually you'll be able to see the effect these changes could have on your financial future. Importantly, we stress test your plan to ensure a high probability of its success. This will include putting in a period of market decline to see how this affects your assets and to test if there's any impact on your financial success or not. Ultimately, your wealth plan is completely bespoke to you and your financial future. I hope you found that useful, and I'll now hand back to Jemma.
Thank you very much, Anna. It was very interesting, wasn't it?
Very much so, absolutely. I think it's a really nice piece of software that we use to really deliver the complex into the simple, and it's much more visually attractive to look at rather than, as I said, this huge, great big spreadsheet I could put in front of you. But what I like about the software as well is we can scenario plan. So we know that if you're investing, markets will fall. Yeah. Certainly throughout a 20, 30, 40-year periods. There'll be periods where they fall. Fortunately, there are periods, much more periods, where they grow. Okay, and if clients are not ready for market falls, then they're probably not ready for investing. But what we can actually show within a plan is we can scenario plan and say, look, you're going to experience, we don't know when it's going to come, but it is going to come. And if we can show you that you're still going to meet all of your goals, then we can say you don't need to worry about the market falls when it comes, because there will be an inevitable rise, capital appreciation after that. And we can really help clients regain composure in that moment when they've got that primeval instinct to run. Yeah. Because that will kick in. They'll be wanting to run, and we say, no, we need to regain composure. So I think finally where wealth planning really helps is we will help you get from where you are to where you want to be. We'll help you with this emotional 200,000 years cave person instinct to run. Yeah. And we'll really build a plan that helps you live the life you want to lead.
Sounds good to me. Yeah. So also what I'm hearing is a lot of reassurance there.
Very
coming
much so.
from you.
Yeah, absolutely.
Yeah. To ride out the rough and the smooth and the ups and the downs and all those natural peaks and troughs. Definitely. I think I've run out now of analogies for up and down. Okay, so we're running out of time on this whistle-stop tour of wealth planning, but we are going to be covering different aspects of what you do in future programmes. And there is still time for people to send in their questions, as you'll be on our live Q&A panel in just a moment. But is there anything that you want to leave people with, or do you want to get straight to the questions?
I'm happy to go straight to the questions.
Okay, so good, because the first one is for you.
All right, okay.
So, Simon, do you think that the budget was a good one?
Well, I think there was no real surprises, or huge surprises.
Not like the one before.
No, absolutely not. That was there was a lot of surprises in that one. So I think this budget had to come across as a bit more calmer, a bit more sensible. Sunak and Hunt have, of course, said they would like to do something and give maybe some tax giveaways, but only when the economy's right and the time is not right at the moment. So it was. We pretty much knew what was coming. There was a big surprise, though, on pensions, where they got rid of what's called the lifetime allowance on pensions. And this really affects high-value pensions. So people with perhaps more than £1 million in their pension fund, there was generally a tax charge of 25 or 55% on amounts above that £1 million. So they've now abolished that. So people with high value pensions, that's a big benefit from them because there's not going to be a tax charge. And one of the real reasons for that, of course, was we've got a lot of NHS consultants that are actually leaving the industry because they're taxed on their income and they were being taxed on their pension without even drawing it.
Yeah.
So the idea is to try and bring them back into the workplace.
Yeah.
So that was a huge benefit. The other benefit on pensions were you could put up to £40,000 a year in before. That's now increased to £60,000. So higher earners, it's an extra amount to put into the pension. But I think next year's budget will be the interesting one.
Yeah.
Hopefully the economy will be better. There should be some tax giveaways. And of course, it's before a general election. So there's always some interesting stuff goes on then.
Absolutely. Thank you so much for that nice, thorough answer. And welcome back as well to Chirag and to Tom as well, who are also here to answer your questions. Tom, put you in the hot seat. Do you think that inflation has peaked?
Thanks, Gemma. I mean, we touched on this earlier, and what we've seen, and I guess there's a couple of things to note. One is that, of course, any inflation report is a backward-looking report. So when we talk about inflation, we're talking about what's been going on in the past, not necessarily in the future.
Yeah.
But we are starting to see signs of peaking inflation, but it remains stubbornly high. Here in the UK, where we've seen double-digit inflation now, it's come back, but it's remained stubborn. And that's been the main challenge. We all know with a degree of certainty that within a Western economy, developed market, inflation will fall. The key challenge is when and how fast.
Okay.
So I think that's the key question. So yes, we've seen peaked inflation is our view. We don't anticipate that to revert back to previous norms quickly, but we do expect to start to see that level come down.
Okay, so cautiously optimistic.
It's what we always say.
Yeah.
Absolutely.
So, Chirag, does that mean that interest rates have peaked too?
I think it's worthwhile looking at interest rates twofold. Are we talking about Bank of England base rates, or are we talking about mortgage rates? I think you need a crystal ball, if I'm brutally honest.
Yeah.
I read an interesting article last week which said interest rates may decrease, and this is Bank of England base rates, may decrease to pre-COVID levels.
Right.
And then all of a sudden this week, there's news out there that we're looking at 3 further rises.
Right.
So it's difficult. It's a difficult one to call. I think it will be inflation driven. Like Tom said, inflation has kind of stagnated a bit. It's levelling out, but it's not dropping as quickly as one may have hoped. And I think the Bank of England base rates will really be driven by that. On the mortgage interest rate side, since middle of last year, when interest rates flew out the roof, mortgage interest rates have been coming down. If you looked at 5-year fixed rates, this time 6 months ago, for example, they were at approximately 5.5% on average. We're seeing 5-year fixed rates on average at 4.5% in today's market. And the general consensus is that mortgage rates will continue to decrease throughout the rest of this year, possibly into next year, which is great news for, mortgage borrowers and first-time buyers.
Yeah, absolutely. And it's interesting that you were saying earlier that people's main sort of preoccupation are interest rates, inflation, and all of this. And this is really reflected in the questions, because we had another one for you, Chirag, saying where can you see mortgage interest rates going over the coming months and into 2024?
Once a 2 in 1.
Yeah, and you did 2 in 1, and you also haven't, like you say, you can never know entirely. You can just have a good overview.
Yeah, and I think it's important to keep up to knowledge in regards to market commentary. There are individuals who are experts in this field. Okay, everyone has their own perception of what might happen.
Yeah.
But I don't think anyone really knows.
Yeah. Yeah.
I mean, it's probably worth noting that one of the areas that we look at from an investment standpoint are things like the yield curve, which is effectively telling us what is the market thinking in terms of current and future rates of interest. So you look at things like here in the UK, you might look at the gilt market. In the US, you might look at the US Treasury market. So, in other words, what rate of yield would I get if I invested for 1 year versus 5 years versus 10 years versus 30 years? Now, normally what you see is a natural yield curve where actually you get more interest by investing for longer. So really, you're buying a degree of uncertainty, so you're being rewarded for it.
Yeah.
At the moment, we've got what's called an inverted yield curve in many of these markets, where actually I'm going to get a higher rate of interest by investing short term right now, because there is an expectation that base rates will continue to rise slightly, but then start to come off. So if I want to invest in a 10-year bond, for example, I'm actually probably going to get a lower rate of interest than if I bought a short rate.
Got it.
So it's quite, that's what the market is thinking.
Okay, that's really interesting. Now, the next question is about crypto, and I know that you sort of thought earlier that the heat had perhaps come off it, but Tom, they want to know, do you think crypto is going to bounce back?
You know what? Crypto becomes a sort of a perennial question.
Yeah.
And I think the things to say is, number one, it's unregulated. Number two, it's not a currency. Currency needs to be sovereign or state-backed in some form or another. It is a transfer of value or not a transfer of value, depending on when you invested. I think it's impossible to say. It was fascinating hearing Simon earlier when he was talking about that sort of herd mentality, which those of us on the investment side we call momentum and things like that. But it's all the same thing. It is, you start to see sort of, it's almost self-fulfilling, and that's what we saw with the crypto market. A lot of people talk about crypto as if it was this sort of inflation protection type asset, but it's not an asset because it's not based on anything, and it's impossible to call.
Yeah.
Which I know
think
doesn't
some
really
people
help.
bought it and still don't know what it is.
Yeah, and I agree.
Fear of missing out.
I agree.
Fear of missing out the herd. Yeah, the horses all panicking in the field. Okay, so now we're going to go to this one. So this is going to be for yourself. So they say, I currently live in Dubai. I've been there several years, but I'm going to be relocating back to the UK to retire soon. What does Simon think are the main things I should be thinking about in planning for that? I'd say jumpers. Bring some jumpers, bring some hats. You're going to be cold.
Right. So there's lots of planning that we can do for somebody in that situation. I think first of all, just simply from a tax point of view, and we're not tax advisors, so we would always encourage a tax advisor to come in on this. But certainly in the UK, some of the rules are HMRC, the tax offices can deem you to be in the UK as of the start of the tax year, irrespective of when you actually arrived into the UK.
Right.
So there is something called split year tax treatment. It's a little bit complicated, but the problem with doing that is if you come into the UK and it's deemed that you're taken back to the 6th of April, a lot of the planning can't actually be done. So some examples, you might have investment gains, and the idea with that is perhaps you might want to sell those investments to what we call wash out the gains, and then buy back the investment before you arrive in the UK. So you've actually reset all those gains. Now you do have to be very careful with that in some jurisdictions because there might be a capital gains tax in the jurisdiction you're about to leave. But in this case, it's Dubai, so it should be a zero tax jurisdiction.
Okay.
Other little things would be if you built up lots of different currencies, and you now got your future liabilities or your future spends all in sterling. How do you get your currency from different back into sterling? And we have a full treasury function and team that can help with that. Or indeed, do you want to hedge some of your currencies? You're not so sure where it's going to go, so do you want to put what's called a hedge in place for the future? But look, there's loads of planning we can do for somebody like that. What I would say is if you're thinking of coming to the UK, either returning or coming to the UK for the first time, think way ahead. Think at least a year, if not 18 months
I was
ahead.
going to say, how long should you start planning?
About 18 months. But I think the key thing with that is the client's got a whole new change of circumstances. Not just coming back, they're retiring.
Yeah.
So everything they've been accumulating, they're now going to go into this phase where you might start what's called decumulation or deaccumulating your assets and spending. So there's probably a whole change of investments and everything that we would need to do for them. So please do get in touch with your relationship manager. There is lots we can definitely help with.
There you go. That sounds hopefully very helpful. Okay, so the next one is going to Tom. And it's, do you think Biden versus Trump will impact American markets positively or negatively? And what threats do you see to the markets from de-dollarization?
Other than trying to say that word, we say Biden, Trump. I mean, those are probably at the Trump end. That's a more extreme end of the Republican viewpoint, and it's not necessarily representing the Republican Party, of course. But Democrat versus Republic, is your perennial issue around American politics, and it does have an impact on shorter term market activity. Republicans are typically seen as being pro-market, low tax, small government. That's always been the sort of one of the cornerstones of republicanism. But Democrats being more sort of slightly more benign and in terms of their approach. I think in that example there, you are talking about one extreme at the of Republicans. What we do see, and this is a strange quirk of US politics, is that it goes through this actually quite frequent cycle of events of votes that will go through that actually gives you some visibility coming through. I don't see any particular worries or concerns early doors, but actually as that debate starts to heat up, that could start to get quite interesting, and it will certainly take on a lot of the spotlight. And you also mentioned dollar deaccumulation. There we go.
De-dollarization.
De-dollarization, I beg your pardon. It's something that's starting to get talked about, largely as a result of some of the narrative and rhetoric coming through from China, potentially Saudi as well. Our view on that, I think broadly, is short-term, really little noise and threat. Most of this will be stemmed from, economic activity from the likes of China. China, let's not forget, as a market, probably makes up about 5-6% of global equity markets. US and dollar, therefore, is about 50-60%. So it's a huge influence. Dollar remains a huge factor in terms of global economies and the way in which different assets price.
Yeah.
It's not a short-term thing. Clearly there is a desire for China to increase their presence globally and to shift away dominance of the dollar. That is a very long-term structural
There's a long way
issue.
to go. When you put it like that, that's really interesting. Yeah. Okay, we've got one for you, Chirag. What are your thoughts on the government proposal that any newly rented properties need an EPC rating of at least a C?
I'm getting all the crystal ball questions now. Right.
You are.
I think it's important to understand what that means. It's looking at the energy efficiency of properties. In 2020, the minimum, rating had to be an E for the property to be rented. The proposal is by the end of 2025 for new tenancies it has to be a C. And then by 2028, it will be any ongoing tenancies, they'll all have to be a minimum of C. We also have to remember that the UK has one of the oldest property stocks in the world. Right? There's a lot of old properties in the UK.
So not very well insulated.
That's just one of the problems, right? The key's going to be, can individuals afford to bring them up to a C standard?
Right.
So if you owned one property, it might be straightforward, bringing it from a D to a C, and it might not cost you much money. But if you own 20, 30 properties, you might not have the cash reserves to do that.
Right.
So it's going to be interesting to see how many properties are sold prior to the 2025 deadline and how many landlords get out of that market because they simply can't afford to bring it up to the C rating. There'll be others that take a longer term view. The yields they're generating may totally outweigh the cost involved. But on some properties, I think it will go into the thousands, and I think that's going to be the key. The other thing to bear in mind, I think it's going to change. The goalposts are going to change. Again, market commentary earlier this week said that date from 2025 might be pushed out to 2028.
Right.
So again, where do we stand? No one knows.
Okay, all right, thank you. So somebody else has got in touch, and I think they were talking to the cash flow plan that Anna was talking about in our video earlier. And this person has said, me and my wife need this. How can we get in touch? Simon.
Absolutely. Go through your private banker, your relationship manager, and we'd be very happy to help.
There you go. So
Easy
just,
as that.
literally pick up the phone. There you go. Well, thank you so much for answering all of those, but I'm afraid that's all we've got time for. But the team will be sharing answers to any questions that we haven't answered in the next Nedbank Private Wealth Client News email. And we've covered a lot, really, in this hour. So Tom and Simon gave us a great overview of the markets and how Nedbank Private Wealth is managing your investments. And then Chirag, of course, explained how they can help you with any borrowing needs that you may have. And then finally, Simon and Anna took us through how to avoid emotions getting in the way of your life plans. And remember, don't follow the herd. Don't be the one that bolts after the horse. It might just be doing something silly. So thank you so much to all of our guests today. Thank you for joining us. I've really enjoyed it, and we look forward to seeing you again next time.